Welcome, everyone. We are coming to you live from the Boston Seaport with an incredible roundtable to kick off our afternoon. Thank you to everybody who's joining us from wherever you are. This event is called Embrace the Movement Live. So this is a collaborative event between Disrupt CRE and CohnReznick, really inspired by the Embrace the Movement campaign created by the CohnReznick team. It's all about the movement that's been created in the industry across asset classes. Today we'll be focused on multifamily, but really since the onset of the pandemic. And so I'm here with this amazing roundtable to kick us off and really talk about the different trends that have experienced a lot of the movement. What are the impacts? What are the outcomes? And where are the challenges and opportunities? So with that, I'd love for each of you to briefly introduce yourselves before we get into the conversation.
Thanks so much. My name is Abby Goldenfarb. I'm a Vice President of Development with Trinity Financial.
And I'm Daniel Nagler. I'm at Cabot Cabot & Forbes. I am the Director of Capital Markets, and we are a real estate developer.
I'm Martha Ney. I'm a Managing Director at JLL Capital Markets, and I lead our multifamily investment sales team.
I'm Andrew Lyons. I'm a principal with CohnReznick, and I lead our real estate valuation practice.
Hi, I'm Maureen Joyce. I'm with Barings. We're a multi-asset class investment advisor. I lead equity and debt asset management as well as equity portfolio management.
Hi, I'm Gilbert Nguyen, CEO of Nguyen Companies, Boston-based organization that develops and operates housing across 23 states in the country.
And for all of you watching, my name is Marielle Ibrahimi. I'm the CEO of Disrupt CRE. I'm excited to be collaborating with CohnReznick again for this awesome event. So without further ado, I really want to look in the direction of Martha and Dan over here to talk about capital markets. Really important topic, and I think it will help lay the foundation for the rest of the conversation as we get into it. So Martha, what is the current state of the market as it relates to capital markets? And again, we're really focused on the multifamily asset class here today.
Definitely would be certainly a different answer depending on which asset class you're speaking to, but it's a big question. It's one that I think we could all discuss for an extended period of time, but just trying to keep it to some of the key themes from the capital markets. I would argue that they are functioning, despite what certainly the headlines are saying, the clickbait that we all see every day, even some of the pains that we may feel day to day in the transactions we're trying to get done. But the capital markets are functioning. There's still great liquidity in the market. There's great demand in the market. Certainly the capital markets in 2023 look different than they did in 21, 22, 2020 even. But we all are seeing that the capital markets are doing what they're supposed to be doing. Now, I think we do have what I believe is somewhat unique dynamic here in the Boston market, in that there just haven't been many transactions occurring, and the lack of data points is making it very difficult for folks who otherwise rely on comp data, who rely on their peers. What is my peer doing to help me decide whether it's the time to sell or perhaps even buy? The lack of data is, I think, part of what is clogging the system and helping preventing transactions from coming out broadly and being made. That all being said, though, I recently had a BOV open from a deal that, actually two different deals that we valued in 2018, 2019, and that we're being asked to kind of take a second look at. And while numbers have certainly shifted, NOIs are different, expense loads are certainly different. There's a lot of that is different than that moment in time. The cap rates were strikingly similar to where I would, at gut reaction, expect them to trade today. So while the capital markets feel very different from these wild few years we all had and many of us enjoyed, this moment in time that we're in doesn't feel all that foreign if you really do pull back the layers a bit and look at sort of the longer history of the last cycle that we've lived in. So there's definitely there's more scrutiny at different levels of the capital stack in the capital markets, whether it's looking closely at insurance costs, tax reassessments, valuations as a whole, and certainly it'd be remiss not to even mention, of course, interest rates, which really is what it all comes back to at the end of the day. But the numbers are the numbers within the capital markets are different. There's still a bit of discovery, particularly again in this market, given the lack of transactions. But we are seeing them healthy. We're seeing functionality. we're seeing lenders of all types, from community banks to life cos, debt funds, and certainly the agencies in the multi-space continuing to prop up transacting. But we're also seeing record inbound demand for transactions in this market as well. So we just need the two to sort of come together and have a little bit more conviction about the stability in the short term.
Yeah.
But I think the long-term horizon is going to be quite healthy with many transactions to come.
Amazing. Before we kick it over to Dan, because I'm sure you have a lot to say, I want to ask Drew, where are we in the cycle? I want you to let you weigh in.
Tell me.
And
Bring it all home for us.
Here you go. And I just want to follow up. You're not wrong. There are a lack of transactions everywhere. And so it just makes it really difficult. And that's in most sectors, not just multifamily. I think what makes multifamily a little bit different is that most of the assets in this space are not technically distressed in the way that you're going to see in the office or in the retail spaces. And so because of that, if there are transactions done, those cap rates really haven't moved significantly. I think there are different reports out there, and depending where you are, it could be maybe a 5 or 10% decline, or maybe something a little bit stronger. I've seen Green Street reports up at 20% for multifamily, which would be significant, and it's okay. We won't do 20% for yours. But I think the question is, well, how long will this lack of transactions sustain itself? And the longer it goes on, then likely the more dip in value we're likely to see. But it's so location specific. It's impossible to think about Southern California, for example, and not say, well, there's going to be continuing to be really low cap rates. And CoStar's their latest report, nationally, 25% of all transactions were still, sub 4 cap rates. So that means there's still some sustaining of really important Class A product. The question is, where are we going to see the dips in some of the secondary marketplaces and some of the Class B and Class C assets?
All right, Dan, it's your turn.
Yeah, we're in an interesting place. The question obviously is, are we here for a short period of time or a long period of time?
Is this our new normal? Is it our old normal, like Martha talks about?
I think we're all hoping it's not the new normal. I like 3.5 caps better than 4 or 5 caps. I remember when this first started happening, when we had the rising interest rates, the fundamentals and all the things that were happening, like in multifamily, were great in Boston, and they still remain very good from a fundamental standpoint. But the capital markets, what we were dealing with was, we just raised a lot of money, so there was a lot of dry powder on the sidelines from the debt and equity side. And we were dealing with rising interest rates. And when we started having more and more of this dislocation, and also not really knowing when it was going to end, so we kept on raising rates, and I think everyone's predictions, it's going to end at 3%, maybe it'll go up to 4%, and then suddenly we just stopped for the first time. And I think now having that a relief where people could sort of say, okay, is this the time where it's going to sort of normalize, and I could sort of predict going forward? And this is before even the banks started failing. So I do wonder, capital markets-wise, if we have some sense of stability in what we think the interest rates are, I think people can start planning and predicting when they're going to do more acquisitions, when they're going to provide more loans. Because when the lenders are out there, they're still putting out very wide spreads on their construction loans, acquisition loans, and a lot of that is because there isn't competition to compress it right now. And so as more and more people are doing that and there's more transactions, we'll have that. But the good thing in the market is, and it's always been, is that our fundamentals are always been there. We've been historically delivering, 7,800 or so units a year over the 5-year period, and we absorb more than that in the 8,000, 8,500. But in our production pipeline right now, it's, 2023 was 5,500 or so. Next year it's 6,500, and it's just not enough. And so we have this thing where we're not delivering enough based on demand. We still have low vacancy, we still have rising rents, and that's just going to compound. So we have all these fundamentals. Eventually, that does make up for a lot of the things that we're dealing with, where we can deal with, lower yields because we know we can make it up in rent. And so that's been sort of the savior for the Boston market, and hopefully that's the case. But obviously, we do need relief from the capital markets to see more transactions, or at least more predictability. So,
anything you guys want to add before we?
Well, the takeaway for me, well, there are multiple takeaways, but one is we are underhoused. So the fundamentals are still strong. Now we're seeing rising costs, rising expenses. Martha already talked about insurance, property taxes. That's going to affect the fundamentals, but certainly there is demand, in part because we're underhoused.
Yeah, absolutely. And it does bring us to kind of this next, category that I want to talk about, which is Abby, kicking it over to you and talking about, the shift to working from home, and it's made us think about resident migration. Has this affected your focus from the urban core? Are you still really focused on the urban core? How do you guys consider?
I definitely think the focus of the shift to working from home has made people search for space, search for quality they couldn't get at a price point they couldn't get in the city, and that has caused us to look outside Boston. We're a Boston-based developer. We have an office in New York, but we are kind of looking in the outskirts of Connecticut and New Jersey, and even looking now at New Hampshire because people are moving there. So it definitely has caused us to look at, we're not going to Florida and Texas where everyone's moving, but we definitely are looking in areas where we wouldn't have 5 years ago.
And that's a national trend, not just here in the Northeast, but some secondary cities, Indianapolis, Cincinnati, these are now, when they have, fairly strong demand generators, where we're seeing a lot of investment in those communities, in those areas, which is going to attract a lot of builders and developers in those areas.
And that's exactly, kind of what we had talked about previously, is nationally staggering rental prices and home values in urban areas are precipitating a drive to affordable, sometimes in a lot of cases tertiary markets, which to some extent was expected, but maybe not expected to still be a trend as much as we are seeing it. I need to touch on, and I would love to get Maureen involved in this, the kind of office to resi conversion, or this conversion trend that is happening more and more, conversation that's happening more and more. Do you want to comment on this? I would love to hear your
Well, I think
thoughts.
it's interesting that you say more of a conversation that's happening, because it's a bigger challenge than the headlines would lead one to believe.
Yeah.
The physical characteristics are very different. And when you look at an office building, you have to look at floor plates, you have to look at HVAC systems, you have to look at plumbing. The stack is very different from what you're going to have in a multifamily asset. So the idea that you can easily convert, I think, is oversimplified. And then on top of the physical characteristics, you have lease terms. You have tenants who are leasing space. So how do you de-lease an office building to make it available for multifamily conversion? And then, of course, it all comes down to the economics. What is the value of that office building that starts to make sense for conversion to multifamily at multifamily rents and where construction costs are today? So I think there's a lot more challenges than the headlines let us all see.
Do you think
at
there
the
are
end of the day.
more challenges than opportunities?
Well, the opportunity will come down to distress in office, and it's really how impaired are office values going to get in order to make economic sense to do the conversion. And there's some office values that are going to get impaired, and you're going to get to the point that it gets close to making sense. But it still has to work from a physical standpoint, too. And I think Gensler did a study, and it was something like 19% of the office properties in the country could be conversions. Most of those are all older buildings that were built to different specifications. And in Boston, the number is even lower. And I think because those conversions have already happened.
Some of those conversions, we've seen in actually Fort Point, where we're sitting, Fort Point and Seaport, a number of those buildings, successful conversions in the past in the city have occurred here. But in the last cycle, many of those were flagged and are actively underway being converted to life science.
Well,
Yeah,
that's
I
the
was
funny
gonna
thing.
Is that the elephant in the room?
Well, every office building that wasn't working for office was going to be a life science conversion.
Yeah.
Now life science has slowed down, so every building is going to be a multifamily conversion.
Which the basis is just 2x when you go to life science, so it makes it harder.
Yeah, it's two different. The economic models are so different as far as what you can get out of a life science conversion. If you believe you can do that for every building, but in multifamily, we're talking about much lower rents, much lower values relative to what life sciences are. So you probably can absorb some of these conversion costs, because the conversion cost for residential is astronomical, a lot of times. relative to what you can buy the office building for. Where life sciences, you could kind of make it work, assuming the building could actually fit the loads and has electricity for it and stuff like that.
Anyone want to comment other challenges or potentially opportunities specifically for the office to resi conversions?
Well, I would add, so I'm a member of the Real Estate Roundtable in Washington, and we're working on legislation that would create a 20% tax credit for that conversion. And I think that that's better than nothing. I think 20% of hard costs is not enough to make a square building with structural issues work. But I think it's pointing to the fact that the governments need to play ball here, because there is, with all these cities across the country, real estate taxes make up such a large part of the operating budgets. These buildings the city can't afford for these buildings to stay vacant. So the city, the state, the federal government have to create subsidies for these conversions. There's nothing worse than an empty office building.
Right, and I think that you brought up many good points. We also talked about the center of a lot of these buildings. They don't have windows. There's no light. And I think it's a major thing that seems obvious, but maybe isn't so obvious to people who want to just kickstart these conversations and say we should be doing this because it sounds like a more sustainable option. So we do hope that we see more cities that are playing ball to incentivize these conversions, because it does make a lot of sense in terms of the impact of our industry, which we know we really have to talk about, and we will talk about a little bit here.
Are you seeing that cities are having challenges also with zoning in terms of kind of going from a commercial to residential use, or is people?
Abby, and the ones that we were looking at, the zoning has been the easiest part.
Really?
There's more parking than you ever need. There's obviously the infrastructure there. And literally, the towns are looking at their bottom lines and saying, we can't have an assessment that's 1/10.
Yeah.
So we haven't found the zoning as an issue, and the financing even has been roughly equivalent to what a ground-up construction would be. It's not penalized for being office.
I heard about a developer that was doing like a live-work model with these buildings, and is that something you've been exploring? Because that zoning is also interesting.
It's really interesting you pointed that out. That's actually key to the zoning change.
Yeah.
If you can describe it as live work, it's very easy.
Yeah.
If you just said, I want it to be resi, you'd have an issue, but there's no guardrails around that.
Yeah.
It ends up being maybe 5% of the people work there, but it helps get the zoning.
Yeah.
And I actually looked at one of those just as an interested party. We weren't going to invest in it, but about 7 or 8 years ago, there was this concept of, I think it was called We Live, and I looked at one in DC where they basically had studios around the core, so to deal with the depth, they had all the workspace in the center, and they had the common area space in the center. I don't know if I
think it's called a
worked.
Google building.
I don't know. Yeah, I don't know if it worked, but it was an interesting concept to try to convert an office building to resi.
We see.
We looked at it too, yeah.
Yeah, we see employers really driving some of that redevelopment of certain neighborhoods, like Google in certain areas. So if you have a powerhouse like that coming in, who's going to attract new kids right out of college or people internationally, now you have an area that's going to have a lot of the components that you need for a successful neighborhood. Then the question is, can we remake those into one building? Where you're looking at different components within that original structure. But I just wonder if some of the vintages of those buildings won't allow for some of the amenities that you all have to put in some of these buildings in order to attract new residents.
It's interesting, and in that regard, the ample square footage, the bad and the good, the inefficiency of the building actually creates a lot of common areas and a lot of amenities, and oftentimes, even a lot of outdoor amenities too, courtyards and things like that. But I think one of the long-term strategy issues is the future of the urban core anyway. So if the reason we're doing this is because jobs are moving out of the urban core, why are we adding people to the urban core? Is that where they want to live? If the reason they were there originally was because of their jobs. So then the question is, do they wish to live in a city at all? Or do they wish to live in the suburbs where they get more for their dollar and more outdoor space? That to me is the biggest question. Should we be adding thousands of people living in these buildings?
Well, it's interesting. I think it comes down to demographics to a certain extent. Millennials are moving out. Our research team showed us a slide recently that showed the out-migration from New York. Gen Z was coming in, though. They still wanted to be in the city. So it's sort of the natural progressions of thing. And I think for millennials, they were delayed in moving out to start their families, and you all know better than I, because you're in that cohort, but it's happening now. And now the replacement is Gen Z, and it's just, how big is that demographic cohort to replace the people moving out?
I'm going to say I'm still solidly Gen X, but I will say that it's really difficult for me to find anybody who's under 28 and owns a car in the city.
Oh, yeah.
Yeah.
Makes a lot of sense. Gilbert, are there any other asset classes that are interesting for conversions?
Well, for decades now, wind development has been focused on historic adaptive reuse. So taking old buildings, old hospitals, old schools. We've done about 40 of those and over the East Coast. And one of the issues there is that the good ones, the easy conversions, have all been picked over. Sort of like in Boston, where the empty office spaces were converted already to life science.
Sure.
The ones that laid out perfectly in good areas, there aren't those opportunities. So really the ones that are remaining are the ones that are very difficult to convert and almost as expensive, if not sometimes more expensive than building new. But we like the adaptive reuse for another reason. One, there's sustainability impacts. You're not bringing in the carbon emissions of new products. But the other is the building's there. And so the zoning and permitting process and approval process is a quarter as long.
Sure.
You're not convincing somebody to add something. You're convincing them to fill an empty building that maybe creating crime issues or blight. So we like it for that reason. But I don't think there's a free lunch there. I think the costs, when you add them all up, are generally the same, but there are other subsidies like historic credits that reduce it.
So things that the municipality can incentivize you, and help you get there as a partner. So Drew, and I really want to ask this to everybody because a couple of things have already come up, but what are those kind of unexpected movements or impacts in the last few years, stuff that it played out in a way that you couldn't have imagined? Really making you work for it with that question.
Yeah, so obviously coming out of the pandemic, everybody raced to go grab a house out in the exurbs and the suburbs. And what I'm seeing is all those values of those single-family homes ramped up by really considerably and in a ridiculously short period of time, and now they're all dropping at that same rate. And I think some individuals are finding that they moved out to the countryside because they were worried it was going to be a continued pandemic, and now the pandemic is gone, and they miss all their friends in the city. So you're coming back now. And the question is, how quickly can they sell their house and find a new apartment to come downtown? So I think just the transition of everyone away and then the transition back, I think, is interesting in some locations. And then we discussed it before, but just some of these secondary and tertiary cities becoming a lot more popular, and not just popular for demographics, but a little bit more popular on the CMBS radar, which I don't think 10 years. We were talking before, Nashville 15 years ago was not really on anybody's radar, and now it's a really important MSA in considering, all property types around the country.
Anybody else have something unexpected that played out differently than you thought?
Well, I would add two really important things from an operating perspective. One is, finding labor to work at properties, right? Just like we can't find labor to work at our restaurants, finding property managers, maintenance workers, security guards, very, very difficult.
Yeah.
And then and that raises operating expenses. The other issue is, as we all saw, there was a tremendous amount of non-payment of rents during the pandemic for good reason. There was eviction moratoria, but that has settled into the kind of ethos of a lot of properties long after the pandemic. There's double and sometimes triple the amount of accounts receivable and missed rent payments because folks don't believe they'll be evicted because they weren't in the past. That actually especially hits affordable housing, which are operating on very low margins. When a tenant doesn't pay their share of rent, that doesn't mean profit gets cut. That means there's not enough money to operate the property. So I think that was very unexpected and is a big issue.
Yeah.
One of the things that I found really interesting was how quickly multifamily operators adapted through technology, whether it was virtual tours. I was talking to someone, and so that's part of your labor issue.
Yeah.
You might not need as many leasing people if people adapt to virtual tours. I was at a conference this week, and there were some prop tech VC funds talking about some of the things they're looking at, but one of them was sort of classes or online direct discussion with residents who can change the light bulb themselves or fix a toilet or do something. And they said it was interesting. Younger people are willing to make that phone call and be taught live on how to do their own minor repairs. Older people are like, I'll wait till the maintenance guy comes to my house, comes to my apartment. So that adaptation to the realities that you talk about, I found was really interesting.
Also, people were home a lot, so they had, it was like wait 3 weeks or
figure it out.
Yeah, and watch YouTube.
No, I'm doing a major celebration over here, hearing you talk about prop tech and even hearing about prop tech VCs. Of course, we know they're there, but been doing this a long time, and it was just like a far off dream to be having this conversation right now. So. Anything else unexpected? We did talk a little bit, in our prep for this conversation about political climate, which we don't need to get into too deeply, but really the incentives, and the different things that the city wants to align building owners with in terms of incentivizing, lower carbon emissions and energy spend, incentivizing increase in affordable housing, things like that. Things that we maybe couldn't have expected, but here we are. Does anyone want to touch on some of those implications?
Being a developer, we see it a lot. We've always seen it kind of in the suburbs because people don't want sometimes to develop in suburbs, but
Sure.
especially in the urban core, the changes, it has been quite dramatic. And, I think that shift, we were not used to. We're used to being like, thank you for developing all that. We're supposed to be partners essentially in the development of new supply, which is supposed to be beneficial. And I think the mentality toward, developers has changed a lot, where we are looked upon as the bad guys. And that's been a little bit of a weird swing to happen, versus not saying someone, you're going to someone's neighborhood, they're like, hey, don't develop in our neighborhood, versus actually city officials actually looking at us as being the bad person for essentially helping to drive growth in their city. So I don't think, and I don't think many developers are looking at this in a way also that we're trying to scrape as much off as we can for ourselves. I think everyone wants to solve some of these problems, and I don't think we want to be viewed as the bad guy. I think we want to be there to be proactive on these solutions. We are, for housing specifically, we have a huge supply issue. Like everything we talked about, we are not developing enough supply either through conversions or new development, and it's not going to help every little thing that we're adding either through additional costs to develop. We're already at a place where it's very difficult to build right now and make the numbers work, and then we're adding on things for essentially to be carbon neutral. That's fine. We should be looking at ways of that, but also for us to foot the bill basically means I can't make some of these numbers work anymore. Yeah. And so it's not as if we don't want to do that, but we're also saying how do we realistically do it?
Right.
And so there has to be a little bit more of a partnership saying, what can we do to help drive production versus looking at us for saying, why haven't you done this? Why, as if we have like unlimited returns on these things. So I think, that's been a huge shift that I wish would change a little bit, and maybe it will after we get through a down economic cycle. Usually it does shift when they say, okay, we do need your help. So we'll see.
Back to the prior question about the unexpected, which dovetails in here to this cost. On the one hand, all these green initiatives, inclusionary housing, these have all been discussed for years. It's just that they're all being implemented in what happens to be overlaid on a very challenging cost environment. So what was unforeseen is I never foresaw massive container ships aggregating outside the ports, right? Outside supply chain disruptions. And all, I've heard of developers, I'm not a developer myself, of course, but I've heard of developers hoarding HVAC units and plumbing pieces that are just, I think some of that has, tell me, some of that has tapered for sure, but
we did a lot of forward buys, yeah.
There's been all of that impacts cost, and so it's already an elevated cost environment, and then you layer on these very admirable initiatives that have been discussed for so much time, but when you kind of add them together, then you add the interest rates, interest expense costs and so forth and so on. It just, it makes it very, economically infeasible to do many of these developments.
I also feel like the permitting process has been the kind of the new norm now for virtual meetings. Makes it really easy for people to be anonymous and throw kind of bombs.
Yes.
Whereas before you'd have a community meeting and people would show up and they're held accountable for what they're saying. And now it's really easy. I've been on them where people are yelling at me, but they're not on, they're not showing their face and you don't know what their name is and they're just kind of, the fake news is happening.
Yeah, and you can meet with them afterwards too.
You can meet with them after. So it's just a slowdown, which, again, for certain projects, we need to build the housing to solve these problems, and this is delaying it.
Yeah, I mean, these are some major shifts in kind of community development and, also from a potentially lack of partnership viewpoint is not driving the end result that, everybody should be looking for, including those communities.
But we should say one thing I think it's been positive is that this new kind of housing choice or the MBTA communities, whatever you want to call it, that initiative, I mean, it's just starting to happen. I think that's actually going to be something positive where you're going to see as of right zoning, it'll basically clear up a lot of things, and hopefully you're able to build housing in, now this is in Boston, but in the surrounding suburbs, and that could be a way for us to get a lot of supply in the market and have some predictability on what we can and can't develop. So. There is that. We're still dealing with, it's still very expensive to build and it's very difficult, but I think the idea that we can find different avenues for supply where we couldn't before is really important.
Can you tell us about what that is and what that's all about for anybody watching?
The state pass or Baker pass right beforehand, that basically, and I apologize to anyone that's a lawyer or whoever's listening, I probably butchered it, but long story, certain suburban communities that are next to commuter rail stations have to deliver a certain amount of units or basically redesign their zoning to be as of right, so you could essentially do it. And I forget what the density levels are, but and a lot of people have been complying, which is actually another surprise because I think there are some that are not, but a lot of them are saying, okay, there is a little bit of a punishment if you don't do it, but our Campbell basically said you have to do this. This isn't like a choice. You can't take the punishment and not do it. So there's been a little bit of a stick, but I think towns have been pretty much proactive on this, saying, okay, we're obligated to do it. And so we've been actively looking at certain suburban communities to find these new places. So that's been interesting to find a new avenue for supply.
And you can't access infrastructure funding from the state or if you're not in compliance with your if your community is not in compliance with these rules.
They were going to take away like affordable, some things on the affordable side, but they realized that would have been a double whammy. You're not building, and by the way, we're also going to take away your funding for affordable.
Yeah.
So.
Wow. I want to kick it over to Gilbert. We did jump, a little bit ahead, but we'll come back. I want to talk about how you're navigating community development and engagement, because I think you have a lot going on in this department.
Yeah, in some ways, I'm of two minds about the virtual meetings. I really like the mute button, so you can't really do that in person. But, one of the things that's very clear is that technology can help you in this regard. There are software programs and web programs that allow you to touch a larger audience, allow positive comments to come in so that it's always not negative, and have like a discussion board. And I think that's helpful, but nothing beats the on the ground, just being in the community at the community events. One of the things we did at our large project in South Boston called Mary Ellen McCormick, which is going to eventually be 3,000 units on the waterfront, was we set up, starting 4 years ago, office hours, Tuesdays and Thursdays, on the site, just for people to come in, because rumors will manifest. And you can work from home. You can certainly work from the tenant task force building. So we had our folks there, and that has really just made us embedded in the community. So I think that's a really good way to sort of win the trust. But ultimately, zoning and permitting approvals take too long in our neck of the woods, period. Even under, what Dan was saying, even under 40B, which is supposed to be as of right in many ways, you can have a 2-year process because people don't like the way the windows are designed or the fire egress. So I just, that no matter how much community support you have, we give too many voices to the naysayers.
You have a program, if I'm not mistaken, called Connected Communities. Is that right?
We
Can
do.
you share what that is all about?
Sure. So this is our resident services platform. So it is basically all of our kind of social worker folks that go into the community and that we manage and help connect to health services, job services, after-school programs. And what we're trying to do is, especially in affordable housing, is show that it's not just the bricks and sticks, it's also the community sense of safety, sense of upkeep. There are hoarding issues that would occur that would end up costing the developer and management company money. There are after-school programs that could down the road head off crime issues. There's sort of a natural kind of combination of charitable and capitalistic intentions that lead to better outcomes. And so we've invested a lot of money in our Connected Communities platform, and a lot of people have been registered to vote. A lot of people have been given vaccines that wouldn't have. A lot of people are enrolled in after school in English as a second language that wouldn't have been. But our vacancy is lower, our bad debt's lower, and in some cases our operating costs are lower. So we really believe it's a sustainable model.
I can't think of another company that really stresses that ESG movement better than Win. You guys do a really effective and amazing job in that.
Wow.
So, I mean, it's really important for a lot of different companies to consider and taking a really active role in understanding like it's really about the people. Is really what drives a lot of that. So it's really great to hear.
Thank you.
But it's also enlightened self-interest, as you said.
Yeah.
You have a better performing asset. You have people who want to stay there. You build community, and so you don't have the turnover, which is fantastic.
And that's how it should be, right? That outcome should be a win-win.
Yep.
No pun intended.
I'll take it. I'll take it. Though. We've used that before.
I bet that's the
really
first.
good coming from
I can't say.
Yeah, you can't say that.
I'm sure that's not the first time it's come up. So I want to jump back a little bit to climate change because we touched on it, but I want to get into it with Maureen to start, if you don't mind. So how is climate change impacting the industry? And this is, I mean, what a question. There's so many directions you could take it.
I think that's the important thing to focus on. There are so many directions you can take it in. When you look at the physical risks that are associated with climate change, heat stress, drought, water stress, tornadoes, hurricanes, which just means wind, all of that impacts your properties and your operations. And when you have people living in these buildings, it's more important than if it was an office building because you have to provide services to them even if there's a storm. But some of the impacts are immediately, Martha said this at the very outset, was insurance. If you look at NMHC's numbers, I think the average cost of insurance premiums this year over last is 26%, and that's average. I've heard of folks who have 60% increases. And when you look at certain parts of the country, wind markets, Texas, Florida, it's more than 26%. If you look at areas where there's other physical risks like heat, drought, water stress, that's a whole other kettle of fish. There was an article in the New York Times a couple weeks ago about what's happening in the state of Arizona focused on Phoenix. Water stress is so great that where they're not going to pull multifamily permits that have been issued, they are going to slow down and look at them because they're looking at groundwater reserves, they're looking at what's happening with the Colorado River, and they're worried about water stress and what that means to the growth in Phoenix. So that's something that we have to think about as multifamily developers and operators, what that means to our ability to continue to grow the platforms. Climate change is really going to affect us all in some way, shape, or form, but you can see in certain parts of the country that it's front and center, and it wasn't that way before. And ultimately, that's going to add to cost because you're going to have to figure out how to deal with, well, for one thing, insurance costs are going up. You're going to have to build resilience into your communities. You're going to have to figure out how to make sure that you're protected against any disruption in the grid with solar or whatever it might be. So it's all going to add up to additional costs.
Yeah. And potential full stop gaps in permitting and things like that due to some of these potentially unexpected changes. But as much as we can get ahead of predicting especially on the climate side, we can do our best, but it's going to continue to affect things like insurance, things like permitting.
In insurance, we're going through our renewal right now. I don't know what you did on your renewal, but talking to the
Try not to
brokers,
think about it.
Deductibles have gone up. I used to joke when we had $10,000 to $25,000 deductibles that I loved a hailstorm in Colorado or Texas because I got a new roof for $25,000 essentially. That's not the case anymore.
That's why our premiums are so high.
So deductibles are going up, limits are being looked at. People are looking at all kinds of structuring their insurance to try to keep that ticket low while still being a good steward of your client's capital and making sure that you have appropriate insurance.
It's crazy, and not just here, but throughout the country, especially, you mentioned some of the states in the Sun Belt and Florida particularly. The average insurance for a single family home across the country is around $1,500 or $1,600, and in Florida it's $6,000. It's just it's unbelievable. It's not sustainable, and worse than just what the premiums are. It's insurance companies are dropping like flies, and they're getting out of the game. So in states that don't have really proper regulations to control those insurance companies, it's going to get pretty out of hand. So it's
going to get, or we're there now.
we might be there.
It's actually a plug for office conversions because
Bring us back.
Because the wood frame market is double what with steel or concrete non-combustible is. So it's interesting. All these offices wouldn't be the where you pay the piper on all these wood frame buildings being built over the last 15 years. Insurance premiums are probably triple what they were when they were under it.
But you look at some parts of the country, South Florida, after Andrew, whenever that was in the early 90s, you went to block construction. Yet Orlando is still a stick frame market. And you'd say, well, it's still Florida. There's still hurricanes. And that's going to change. Construction is going to change because of those issues.
You can see it in markets like Myrtle Beach, where all the new developments are usually a story up. With parking underneath. So we're going to see that a lot more on the coasts, up and down the coasts, for sure. But, the good news is that, President Biden did sign the IRA last fall, which adds some pretty major incentive for developers like you for affordable housing, specifically in looking at elements of their development and components to increase basis and help you guys on the bottom line. So really easy answer to climate change is build more affordable housing.
Well, the other thing, you can speak to it better than I, but the regulation part of it, Birdo in Boston or other things that you're facing, I'd be dangerous if I tried to get into that. But it's a net zero requirement over, till 2050.
We're trying to lean into it in a way that is, and embrace it, because in New York, the situation is a little different in New York, where affordable housing is typically non-union. So the costs are a little lower, but we just completed a 26-story passive house building, the largest passive house affordable housing development in the country. And it was, now that building is basically, we need to replicate it in other places. But it gets hard when the construction costs are not,
I think you'll be paid at the back end though. Because I think of resiliency as physical risk, transition risk, but then capital market risk. At some point, having a green building is going to be worth a whole lot more than having a building.
We're seeing it on the inbound investor side. I mean, we're getting more and more folks looking at opportunities, and one of the first questions is, does it have a LEED certification? How is this built? When is this built? And there are some folks who, if you don't have a good answer or the right answer, it's the end of the conversation. So it's not the majority, but again, all these things take time. And I do think in due time, there will be a separation of those that have it and those that do not.
Absolutely. So speaking about all this, how are all of you come from a totally different context and different niche, different specialty, but how are you kind of navigating creating more inventory while also abiding by some of these, kind of new building regulations? I dare to ask. Nobody jump in here first.
I mean, it's difficult. I mean,
Yeah.
a lot of times we've changed a little bit of our strategies. I mean, as far as a site that was good for multifamily 2 or 3 years ago is a great life science site right now. And the numbers work, obviously we're dealing with our own blip in the market right now in life sciences, but in general, the values and everything in order to get something under agreement, I mean, landowners are looking at it that way too. They're saying this guy will pay more for it, more more per acre or more per FAR foot. So, it is hard to find supply. Again, I think what we talked about with some of this housing choice going in, these are not life science areas. If you're going into some suburban markets and they're next to the commuter rail stations, those would be good avenues for us to create some housing. And obviously you could build it a little bit cheaper if it's outside the downtown area, because you could build, a little bit mixed bag or non-union, which saves some costs. So you could find ways to create supply there. But it's hard to do it in the urban core. I mean, I don't know if we've looked at any downtown Boston or anything for a while. We're developing one in Fenway. I don't think we could do that one again, So, and we had one in Brighton, which we did, and that one, was a wood frame deal, and it's still, I don't know if we could pencil that today. It's very difficult to build and do supply in Boston. And then we were talking about before, environmental, like there are different things that we have to do now that we didn't do before. We were already building to stretch energy codes, so we're already doing more than most of the country. And then you add on that you got to be carbon neutral, so you basically all electric buildings. Operationally, that's not cheap. Natural gas is generally cheaper, and then also the building of it. I guess you pre-plan for it. But then Birdo, when people that are we're not long-term holders, but you guys are going to have to figure out what do we do for that, or how do you offset, and those are costs. And obviously, if there are ways for the government to help, then that makes it a lot easier. Then long-term it'll be great, but a lot of times the burden is always on us, and that goes back to the negative. They always say, well, you guys should be able to afford it. And a lot of times we're dealing with such small margins on our deals that we really can't.
I guess I would add to that. From a affordable housing, kind of mixed income workforce housing developer standpoint, it's painful, but there is at least some elasticity in market rents, right? Mm-hmm. If everybody is held to the same standard of green, sustainability, affordable housing, a $4,000 a month rent can become a $4,500. It's painful, it leads to inflation elsewhere, but at least there's some ability to be elastic. In the affordable market, people earn what they earn and they can afford to pay 30% of their income. That's not changing in the same way. So all these added requirements for environmental, for retail, for outdoor space, for, all they do is require more subsidy from the federal government to build affordable housing. Yeah. And the state government. So it's very interesting that these are almost competing interests. Is a tree more valuable than a person? Is the floodplain more valuable than a community that exists today? Probably you could have arguments on both sides. But what we know for sure is that it costs more to build affordable housing, and we can't do anything on the source side, the rent side, other than get more subsidy.
Right.
Yep.
You go ahead.
You want to go ahead, Mark?
Go ahead.
This is going to sound a little bizarre, but all I can think about is Jackson Hole, Wyoming. So Jackson Hole, because it's so limited in the amount of land that it has, anybody who wants to build a new business or a new building has to incorporate workforce housing on their property. And it's a significant expense. You build a hotel, you've got to put 20 affordable units on your property to house the people, because there's nowhere for people to live, literally nowhere.
Wow.
That's where we're probably driving. You have major affluence, people who have very expensive, high-density real estate in downtown cores, and climate change is going to reduce a lot of that land area. And so you've got to think ahead. And how can more governments and corporations and companies strategize about how to add more mixed income into their development plans?
I just to jump in, I think that is the future, and I think it should be the future. Yeah. I think that the days of the company towns and everything else, where are the major corporations that are bringing 50,000 people to work there? Where are they on helping finance workforce housing? I think it's natural. Yeah.
It has to. I mean, I'm looking around in the Seaport, and I haven't been here for a few years, granted, but I mean, I'm seeing buildings left, right, and center that frankly just didn't exist a few years ago. And so talk about a density of population in a city that, is highly susceptible to climate change. I don't think we have a choice aside from those partnerships to move in the right direction. Incentives from municipal are incredible, but it's getting them done in a way that's effective and helps you all also, do your jobs effectively and have business and thrive. So, Maureen, did you want to comment on how you're kind of navigating some of these regulations, but still kind of?
We're on the investment advisor side.
Okay.
So we're talking to developers coming in who presumably have solved a lot of those issues, because by the time they get to us, we're looking for projects that are more shovel-ready. The issue for us is where interest rates are and where deals are penciling out. It's a little hard to say yes to investments that are coming across our desk right now. But I think that's hopefully that's going to start to change. I think, and you all know better than I, in some markets, construction costs are at a minimum leveling off. Sometime, lumber, some things have started to decline. I think labor is going to still be a problem. I don't know when that's going to level off. And so what's left? The retrade on the land. And I don't know if you're going to be able to do that. So to make the deal work.
It's actually, we only touched very briefly on supply chain, but it is a major part of this conversation. I know it's a major part of the Embrace the Movement campaign as a whole. It's one of the pillars. So I'm sure there's a lot more on the CohnReznick site, I imagine, about this, where you guys can dive into the research. But thank you for touching on it, because it wasn't part of our original intention, but it's a major thing that needs to come up. I would love to ask Drew about, and Martha, and whoever else wants to chime in, but how are we valuing properties today? What are they worth? How do we know?
We might have different answers. The broker and the appraiser.
Yeah, that's great. So I don't have as many white hairs in my beard as I think I do, but I try to draw as many parallels as I can to some of the other times in other cycles, and just understand, well, where are we? Is it a flight for yield, or is it just a pull-in, waiting to see what's going to happen? So I start there. Second is, when the transactions aren't there, you have to talk to more people. And so just a lot more interviewing, picking up the phone, talking to brokers, talking to investors, and understanding, well, what's going to qualify them to start putting money down on the table, and trying to think through that. And then the other thing is that some of the simple metrics, like just direct cap rates, are no longer reliable. And so that really means, okay, well, I'm going to predict that we're a year and a half out from things starting to get better, and really concentrating on a discounted cash flow as opposed to just dropping a cap rate on a stabilized asset and calling it a day.
Yeah, I mean, valuations are, we're very forward-looking, being in the brokerage world, and there's a wide reaction of how we value things depending on who you're talking to.
I imagine.
I mean, again, I said it on the beginning, but so much of it just comes back to the interest rate environment, the cost of the capital, whether you're an unlevered or levered buyer, because even the unlevered buyers are very cognizant of not overpaying to their competition who may be levering. So, there was a moment in time earlier this year. This year is only not even 6 full months old, and it feels like an eternity in some ways, because it's moving so rapidly. But there's this moment in time when doing BOVs that you could look at the levered returns, you could look at the unlevered returns, you could look at the cash on cash, but really the governor was, when do I hit positive leverage? And then how long will how long will investors tolerate negative leverage? And then kind of backing into the value from there. Now, we've seen some capitulation on that. I would say earlier this year, there was a more sort of resounding response from the investors saying, we'll accept negative leverage for 18 months, and in some cases 24 months, if that's what it took to get as sort of a cost of entry to the market. And that has, in most cases, peeled back to about 12 months. And there's some folks, I was with someone this morning, an institution, who could easily sit up here with all of us. It was like, we won't touch it, negative leverage. And so there's still this very split opinion of the impact of negative leverage or that inflection point from the negative to the positive on the actual valuation. But then again, the few trades that we have seen in the market or that are currently under contract that we understand kind of where those, hear about what's under contract and what those price points are. I mean, they're well into the 4 cap range, and the cost of debt is certainly starts with a 5 handle. So on the one hand, we can use all the logic and the numbers and the spreadsheets and the formulas, but on the other hand, to register these trades, it just takes 1 or 2 to move that pack, to log these data points, to then make the market. So it is interesting that we're all hungry for data points. We're all waiting for a couple key deals in the market to officially close and get that data on the board so we can look to it and rely on it hopefully going forward. But until, 1 or 2 deals historically has not made a market, but that's all we have right now. And so it's, we are the most aggressive buyers in the market right now are absolutely comfortable buying in a negative leverage environment. And for what was, maybe outwardly they'll say for 12 months, but the reality is on their performance, it's probably longer than that. And that's not everyone that shows up to bid, but that is who is winning the day today.
What's the makeup of your bidders?
You have a lot of, private equity, high net worths, like uber high net worths in their offices. It's not core.
Yeah.
It's not the institutions, it's not the core funds. But we are starting to hear, it's REITs in some cases, we are starting to hear of core funds wanting to get back in the market, and there's this concept of what I call sort of inactive and active capital. We get lots of conversations saying, we're looking, let's tour, let's underwrite, but we all know, and they won't tell me, but they're submitting to be a part of a process and gain data, but they're not intending to win. If I call them back for a second round, it's,
Are you seeing the pressure? Because there was a lot of capital raised before this interest rate environment. So there was a lot of, and that was kind of, you look at a lot of the large funds that were raised, and I know they've been sitting around thinking, well, I'm going to wait till there's good buys.
Yeah.
And obviously in Boston, that's going to be very difficult because there's not many trades already, and most people are just going to hold out anyway.
Yeah.
So are they starting to push? Because that's, once that starts happening, then people start looking at the fundamentals, and we're going to start seeing huge rent growth again.
Yeah.
Because there's not enough, again, we're at low vacancy, low supply.
I would say yes-ish. There's still,
Yeah.
it's still a very
when
split
the dam
audience.
breaks, yeah.
When does it's sort of like, when does the lender come calling for certain product types? When does the dam break and you have to invest that money and start earning that return? We are, like I think as I said earlier, we have seen more people coming and identifying Boston as a market they want to be in, whether they've never been here before, they're actively here, or they're wanting to return to the market. So there's no shortage of desire to get here and invest here and be a part of this conversation. There's just not enough deals for them to chase. So, I will say maybe as a, we're talking about Boston, I would say Boston, I mean Greater Boston, but Greater Boston's geography for many is expanding. I've had more conversations about Nashua and Portland and pockets of Connecticut, pockets of Rhode Island, and those are markets, I mean, certainly Worcester could be it has been its own panel discussion because of everything that's going on over there. So I think there's an understanding that the bullseye has to expand if you do have some of these pressures. I think probably making that happen. All of these markets that I mentioned, these secondary markets, you probably get a little bit more yield. They've all been very stable markets. Nashua is part of the Boston MSA, which many people, New Hampshire can be very polarizing, and some try to deny that, but it is, and it drafts off of everything that comes out of the city of Boston. So I think that the pressure to deploy is there, and we're seeing it play out in different ways, but one of them is certainly the expansion of the geography to which you can invest in the Boston MSA.
Which is interesting because, going back to what we talked about at the beginning, people working from home, if you had to drive in to Boston or to Burlington from Nashua 2 days a week, you could handle that.
Yeah.
If you had to do it 5 days a week, you wouldn't be living in Nashua.
It's true.
Absolutely. Any lasting thoughts? I would love to ask another question, but we just don't have time, so I'll let you guys chime in where you feel like it. No? Anybody want? Oh, Abby, please.
I was just thinking about how the pandemic, just that whole experience, how it changed things. And, from us, I actually met someone running for city councilor yesterday, and she said, I'm young, but I raised $1 million while in my pajamas, from home. Things have changed in just a way across the sector, from community outreach to permitting to financing and construction.
Well, I think it's humanized business in a lot of ways, right? And I think the appeal, especially in commercial real estate, it's so amazing that we can do this and we can have a digital audience that's tuning in from wherever they happen to be, and they're appreciating that we're just honest and vulnerable in our truth to a large extent. I mean, this is a beautiful thing. These kind of conversations hopefully are happening more and more in person and online, but off of Zoom, right? Because to feel someone's energy and get to know them a little bit as a person, and hopefully we get to have a cocktail later this evening, you can't replace that, or whatever beverage you like. But truly, like the human factor of doing business, especially in commercial real estate, we can feel very removed, or others, I should say, can feel very removed from certainly a panel of executives such as yourselves. So I appreciate the energy that all of you brought today, and certainly to our next session that will join us, and hopefully the folks that are watching, you guys got to be engaged and feel like you were part of the conversation and feel like you were sitting here with us. If you guys want to answer some of the questions that I'm sure are in the comments later on, please do. That much we couldn't do. But I think there's a very human element that's been introduced that we maybe didn't have before that I think is really incredible. So I hope you guys all are feeling that in your day-to-day.
I think we've all been vibing off of your energy that you've given to this panel, so just appreciate you and
Thank you.
Thank
really
you,
nice
guys.
job.
Awesome.
Thank you.
Well, this has been really fantastic. Thank you so much. Thanks to everybody who joined us. We're going to be back in 20 minutes for another incredible session called Performance Improvement, Operating Models, Trends, and Best Practices. So don't go away. We'll be back in 20 minutes. You can watch, you can listen like a podcast. That is the beauty of this format. So stay tuned, and we will be back shortly. All right, welcome back, everybody. If you're joining us for the first time, my name is Marielle Ibrahimi. I'm the CEO of Disrupt CRE, and we are here collaborating with Cohn Resnick for an amazing event called Embrace the Movement Live, and we are focused on multifamily real estate and all the movement that's happened since the onset of pandemic in the industry. And so we just wrapped up a multifamily spotlight roundtable. Hopefully you were with us for that one, but now we're here focused on performance improvement, operating models, trends, and best practices. We have a lot to unpack, and I would love for each of our roundtable participants to first introduce themselves, starting with Noam right here.
Sure. Noam Kleinman. I'm with Foxfield, a private equity shop in Boston, and I oversee the residential platform.
Beautiful.
Jim Whalen, I'm is CIO and CTO of BXP, former Boston Properties. I've been there 25 years. We're the largest developer owner, publicly traded owner, developer, and manager of premier workspace in the US. So.
Amazing.
Great, and I'm Julie Kittler from AEW Capital Management here in Boston, investment advisor, and I am the head of our multifamily asset management team. My role is really to focus on driving investment performances and best practices across our 10 billion, 100 property portfolio. And I think, we talked a little bit before we started about maybe making this personal. I think something interesting about me that a lot of people don't know is that I've been at AEW for 30 years, and my first job at the company was administrative assistant. So for all of you out there at the bottom of the, I shouldn't say the bottom, that's not the right way to say it, but who are just entering,
yes.
I did not know what a cap rate was when I started at AEW. I knew very little about real estate, so there's plenty to learn in the field.
Wow, Julie, that's incredible. Thank you for sharing that.
Yeah.
Amazing. One of the movements, the big movements that we were talking about at the close of the last roundtable was just this element of being human and how much that has changed and how much that's been celebrated and embraced in our industry over the last few years. And what an amazing thing. And getting to know each of you, hopefully a little bit more, not just from what you do in your everyday lives, but the things that inspire you and motivate you is fantastic.
Makes it a lot more fun.
It makes it so much more fun. Thank you so much. Paul, no pressure.
Paul Ricci, I lead the Technology Plus group and Real Estate Advisory group at Cohn Resnick. Technology Plus basically helps clients with their end-to-end technology problems, from strategy to selections to implementations, support, project management, change management, all those things. So a little bit about me, just following up on what Julie here said. My first job was as a toll booth operator at the Jersey Shore, the original exit of the Jersey Shore on the MTV show. So there was a lot of the situations and such coming by the booth. So that's fun, and here I am, partner with Cohn Resnick.
That's hysterical. And you have your hands in quite a few things, it sounds like. So you get to see a lot about this industry happening.
Yeah, owners, operators, investors, all the different asset classes up and down the stack. So it's a pretty interesting job. People ask me, like, do you have a desk job? And I say, well, I have 10 desk jobs, because you have all these different clients, and you get to see the good and the bad. So, and I aspire to be Jim. Like,
don't we all? I mean, come on.
He's the guy. So.
Well, and I think another really interesting movement that's happened, it's been happening, but kind of the onset of the pandemic to help accelerate this was a lot of, first of all, new jobs that are created for the first time that maybe didn't exist, but also some of these roles having a multifaceted, approach. So being able to have your hands in so many things. Jim, you being a CIO, CTO, I'm sure you're not only collaborating with your team, but maybe even HR and business units that never entered the chat, so to speak, beforehand. I would imagine.
Yeah, I mean, like our model is, we're a decentralized organization in 6 markets, and I need to find common denominators that work for the company. So it's a much more of an influence model of kind of getting people around a consensus around the adoption of technology, and so it's just but you're definitely right, and we also have a lot of younger voices, younger demographics in our company. So how are you responsive to their expectations and their needs, right? So.
which is a huge pillar of diversity that I think goes unspoken often, is kind of this age diversity. So I love to hear that. I think that's amazing. Noam, give us a little bit of background on your trajectory. How did you get to the position you're in now? What's the
I
path?
started my first job when I was 13 after school. I worked as a surveyor, and my job was to hold the stick while the survey was taking place. So I was always in real estate somehow. I grew up in Israel, and I moved here after I finished my military service. And I've kind of done most things in real estate. If it's construction and actually, doing sheetrock and paint and carpentry. I did advisory after business school, worked for PPR at the time, and did advisories to some institutional investors. I've been on the buy-side analyst at Franklin Templeton, and finally into more direct operations, acquisitions, and asset management of predominantly multifamily. But I did also work in industrial for a while, so
Amazing.
I get around.
I love that. There's quite a bit of development happening in Israel too. That's a whole separate conversation in and of itself.
Yeah.
I would love to invite another roundtable participant to join us in just a moment. So if the team could grab Sal a mic, that would be awesome while we jump into some of the questions. Thank you guys, and we'll just make some room for him on the couch here if you guys don't mind. But so starting us off, because we're here to talk about operating models, and it can mean so many different things, right? So Paul, can you kind of break it down, define, I know it's a lot, but define operating models for us if you
Yeah,
can.
you'll probably get 4 different answers for this question. And I'll try to do my kids proud by not use the word operating or model in this definition. So I would say operating model is kind of a blueprint for how a company delivers its business strategy. And it's the combination of the capabilities that you need, the technology that you use, the business processes under those capabilities, the organization structure, people under that organization structure, of how it comes together to kind of deliver business value and transact the business.
Yeah, okay, amazing. Thank you. So Noam, I'm going to kick it down here.
Yeah.
What are some of your goals in approaching your operating model?
I think I think at the core of every business, you have to understand who the stakeholders are. And predominantly, our 2 primary stakeholders are our residents and our investors. And we believe, basically, that by enhancing our residents' experience overall, we will lead to better dividend in the long term. But everything kind of comes down to, I like to simplify things. Everything comes down to that core understanding. Now, within that, you also have a lot of tools to help you do that. Some of them are very technical tools. Others are more on the qualitative side. From a qualitative side, what I found, and what really was something that came around through the pandemic, I think the previous panel was talking about discovery of cap rates and where the markets are. Well, I think a lot of people went through a discovery experience during the pandemic, individuals, what's important to them and whatnot. And we hear about companies listening to their employees about what's important to them. Well, I think that owners also need to have this kind of discovery. So we've been spending a lot of time listening to our stakeholders and understanding, like, what do they actually need.
That's amazing. I'd like to welcome Sal. Hi.
Hi, how are you?
I'm wonderful. Thanks so much for joining us.
Great
why
to
don't
be here.
Why don't you give us a little brief introduction on who you are, what you do? That'd be great.
Sal Lupoli, owner of Lupoli Companies, founder. We own and operate about 6 million square feet of real estate throughout Massachusetts. We're the 4th largest developer in the state of Massachusetts.
Wow.
We have over 1,000 apartments and about 4.5 million square feet of office, retail, commercial space. We have, respectfully, humbly, we probably have one of the larger pipelines in the state right now of shovel-ready, permitted sites. We have over 2,000 multifamily units approved, permitted, and we have about 1.5 million square feet of mixed-use development of commercial office, R&D, maybe some life science. We're permitted to build all that.
So Sal, we are here talking about movements and some of the major changes that have happened since the onset of the pandemic. So how are your priorities a little bit different today than, what your company maybe traditionally focused on, and what was the trigger?
Yeah, I think what's exciting is, we pivoted very quickly at the beginning of the pandemic because we cross all those sectors that, the pandemic affected, and we felt that multifamily was the least affected. So very quickly in the first couple of months of the pandemic, we went back to our lenders and we went back to our architects, and we turned probably 100,000 square feet from office space that we were building into residential.
Wow.
So very quickly we pivoted into residential, and we're proud to say that it came online. 338 units just came online about 6 months ago. We're 98% occupied, and all market rate product, by the way, workforce housing.
Incredible. And we did talk a little bit in the last session, for those of you who are with us, about that kind of office to resi conversion, some of the challenges, some of the opportunities. So if you didn't catch it, you can watch the replay later on once we're finished. But a lot of interesting conversation in that realm. So thanks for sharing that. And I know in our prep for this conversation, you had talked about some of your priorities shifting in terms of adding amenity space, looking at that work from home trend and really adjusting for that, and that's pretty incredible.
Yeah, we did a couple of things. First of all, we went all in on geothermal energy, and so out of a total now of 600 units, we burn no fossil fuel, which that's a big deal to the residents. Not only it brought their cost down, right, because they're not paying for the cooling of the AC or creating the flame for the heat, so to speak, but we also created additional space within it. We created these nooks within the apartments very quickly, so it doesn't put the home office at the kitchen table or the dining room table. It puts them in small little areas, much like we saw today when we were walking in. So these small nooks that we created, which is a big hit in the residents, and then we expanded the amenity space greatly, 3 to 4 times what we anticipated. We didn't put the amenity space on just one floor. I put it on every single floor, and I put it at both ends of the building. So you didn't have to walk very far to utilize the amenity space because we knew we could see the trends. So it's been very effective.
That's a big deal. And so we're in a beautiful industrious space in downtown seaport of Boston. And so you get a feeling of that here, but to hear about it being implemented in such an extreme in multifamily is unique. And I think I would say that's a major movement that's happened since the onset of the pandemic.
It's really amazing when you go around and you see property where people do it right and you see those spaces activated. It's exciting to see. And I don't know if it's still fair to say like the Starbucks model kind of works well, where there's some spots where the industrious model, where there's some spots where people could go behind doors and have private conversation, but also the bench seating. But there are places where it's not done right too. And sometimes we scratch our heads a little bit on what makes it work or not. And sometimes I think it's the demographic or where the asset's located. But that whole idea of adding, spaces that people can use outside of their apartment and as an extension of their apartment is definitely, it was there before COVID, but COVID totally accelerated it.
Same thing in the office side, so it's happened in our platform.
There's a lot of amenitizing on the office side as well. But I think it's interesting because there's the functionality of the working from home, and I need a place in order to work from, have conference, take calls from. But if residents are staying home for a longer duration of time, they also have other needs that the property needs to answer. And one of them I've noticed is a sense of community, especially on the rental product where you tend to have a younger population. They got a lot of community through collaborating with their peers in the office space. Now they're not in the office as much. So they need a sense of community when they're at the home, right? And that's another component of the amenity space that we're seeing kind of used.
Not only do you try to create the amenity space, or our organization tries to do inside the footprint, but I think what's very important is all of our large-scale projects, it's a campus-style, opportunity where outside of the building, separate, fee simple, we're creating retail applications, we're creating the office application. So, you might have the place where the doctors are and the lender and the banks are, and you have the coffee house and you have the small restaurants. So it's not only the amenities inside the space, how do you backstop that with amenities outside of the building, but in close proximity? Does that
Further
make
into
sense?
the community, absolutely.
Yeah, so you have a community within the property, but you have a community, greater community around the property.
That's correct.
Well, that sense of convenience, sorry, Julie.
No, go right ahead.
That sense of convenience, I think, is certainly growing. We're seeing that through all of our clients, especially on the multifamily side, where people want that convenience, very central.
So as a selfish investor, owning and operating the retail is never my choice. I would much rather have it around the corner and operated by a retail expert. The pandemic was hard on retail, right?
Sure.
And so in many places where we've developed our own high-rise, where there's a requirement for that street level to be retail by the city, the municipality, sometimes, and you see it in Boston, you can see it, I don't know if it's still the way, I haven't been there for a while, but over near.
The real estate industry has been struggling with homogenizing data across systems, especially with more and more devices in the buildings every day. I'm curious if it's changed since the onset of the pandemic, but how are you using data to kind of further the efficiencies in your business?
So, I'd like to think that we're a data company. We've been. I always say that data is an intentional journey with unexpected results in the journey that you undertake. But we pivoted back in 15 years ago, in 2008, to being a data company, building capabilities, and we saw it as a competitive advantage, right? So we built. I have a whole data team, data architect, and we went after financials, went after projections, space, then focused on energy. It really started to any of our partnerships that we do, any solution providers, we expect a data play with anyone we do, right? And more recently, I've got IAQ, indoor air quality, I've got occupancy. I'm sitting on a warehouse of 70 million card swipe records that we started to build in 2018, really understanding what's going on in a good majority of our buildings. Just where we have perimeter control, like turnstiles and things like that. So it says, again, I'm a technologist. So there's a technology component, there's a people component.
Yeah.
There's technology, just real quick, is just been completely enabled by the cloud. The last 5 years is revolutionary. The approachability of these tool sets and capabilities that you can bring in and exploit. And now with AI, just the extension of these capabilities.
Okay, hold on, we'll get to the AI part.
I know, but just that's a quick comment on just the enablement that has really occurred. And then the second is really the people side. How do you get people to integrate these data points into their daily work, whether it's alerts and that takes data is an iterative process, right? You have to kind of keep at it. It requires sponsorship. It requires a structured engagement to get to people to literally bring it into their work and their role, right?
I imagine trust is a huge part of that, right? Especially since the onset of COVID and privacy concerns and things like that. Are people still concerned? Because I know people feel like we give so much away and they kind of almost throw in the towel to privacy.
Well, you have to. I think as a company, any of us. Again, your multifamily is different from office, but I think you have to have some precepts and fundamental principles of how you treat data. Like we never sell data. Like we aggregate. We never. Very, very conscious about where we cross these boundaries and staying around the privacy of our clients, especially.
If the people aren't concerned, the government is. Especially in California, there's all kinds of privacy laws.
California
has become a big topic when we're talking with our property management companies around protecting the data and who's going to kind of be responsible.
Yeah, so as a platform, you're always trying to do, like if California is a standard, that's the denominator we need to set.
Right. So one of the things I know you said bringing us together was that we create these great relationships. Everything you just said is fascinating to me because we don't have in-house management. We're not a vertically integrated company. We work with all kinds of different partners and managers across the country, and I chase data all day long.
Wow.
Right? And to be able to pull it all in from the variety of sources is a challenge. It's exciting, and we've made a ton of progress, but it's really challenging. And I think when you have sort of control of it all from where you sit, I think it probably makes it better. But I bet there's 1,000 lessons learned you could share with me that I'm going to hit you up on later on this.
I knew you two would get along.
Yeah.
You next to each other for a reason.
I'm sure everybody's hitting Jim up in the industry, but I'm next in line.
Yeah.
But one of the things that I think we've spent a lot of time on, because we have that challenge, is really working hard to pull in a lot of different data, a lot of different data points, whether it be basic property operation data, whether it be around what's going on in the insurance industry right now, what's going on with debt and our loans, and kind of all of the structure around loan covenants. I mean, it runs the gamut, whether it's property operations or investment KPIs that might help us make good decisions about wholesale strategies.
Yeah.
But trying to bring them all together in one place where we can marry them up so that we can report on them and then use them really to drive performance and make good decisions. It's pretty challenging, and I think, I don't know that I've heard the word data architect, but we have a 30-person IT team. It used to be, I remember when it was like 4, the help desk, and more than half of them are data, right? And so there's a big commitment across the industry and at AEW for sure around data, and figuring out how to do it right is super challenging, I think. But we're making progress, and I think there's some really good tools out there that we're deploying. And honestly, I don't know if you've had this experience as well, but we'll try things, think we picked the right vendor, and a year in, we're like, that's not it. And you can't sort of be afraid to say, this isn't what I thought it was, and now I need to pivot, even though that's hard, painful, disruptive.
Yes.
Feels like a backward step, but you have to be ready to
And I know, just as a note, we never commit to a 3-year. I always have an off-ramp after a year.
Yeah.
I mean, always on any contract. So it's just, so you have to think about that in that frame.
Yeah, and I don't know, part of that is so many are backed by venture capital, so they change. They buy each other. Their motivations are slightly different. So it can be
Well, the tech is evolving just the way the tech is evolving in consumer technology, just like it is for our
even
industry.
knowing which ones to pay attention to. I get somewhere between 25 and 50 emails, or not calls anymore, but emails, a week. And
I only email you like 10 times.
figuring out which one. And you feel rude. You want to be nice. You want to be personal, right? Like which
course.
ones to really spend time, or have your team spend time on.
Right.
It's challenging. Yeah.
Part of it is the technology. Part of it is the data that the technology handles. A lot of the technology that I've used, at the source of the data is human input. And if you can't control for the quality, then you end up making decisions based on faulty data. And that's one of the challenges I found the most, is how do you ensure? I have used third-party services that are supposed to give me information about properties. And I have looked up my own properties, and the information is not correct. So then you ask yourself, how good is the technology if the data in it is not what you're...
Yeah, I think technology is only half of that equation, right? The governance around that technology is so important, especially as we're getting outside data, inside data, IoT type things, and how to translate that. So you need that governance. You talked about kind of how you do it right. Like you got to keep it right at the same time. So putting those governance processes in place, and data owners who's going to take ownership of that data to ensure that it is correct, there's quality around it, and people are verifying that data before somebody's relying on it. Super important.
So that requires a governance team, essentially. I mean, I spent a full day defining market rent with my government's team. Like, it's no small task to do
I mean, a full day is quick on that.
Oh, yeah.
I've been in, it's like when you're
And then
talking about
occupancy,
same store or,
It's
like
important, though.
all these things.
Yeah,
like,
so it's coming back to, it's an iterative process.
Yeah.
It is. Yeah. Well, you said something about kind of putting it, you didn't say it this way, but I read it or heard it as putting it in people's normal day-to-day jobs so that they're forced to look at it, use it, and verify it as part of their jobs, rather than this thing that I have to do off to the side.
Yeah.
Makes
And
sense.
again, it takes structure and just, again,
Right.
keeping it. And sponsorship.
Right.
Sponsorship.
I also, you mentioned, data being not 100% right, and it's super frustrating, right? You spend a lot of time, and you produce the report, you've got the results, then you're like, ugh, something's wrong here. I kind of learned to accept 90%'s okay on data. I just had to, because I kept throwing everything out.
Yeah.
And knowing that it wasn't perfect, and trying to put that asterisk at the bottom of every report.
I think this is going to be an ongoing conversation for as long as we are all working in this industry. I mean, we had the very first Disrupt CRE down the street at District Hall here in the Seaport 9 years ago, and this was one of our very first panels was data.
Right.
And we had, the birth of, we had CompStack, we had VT, BTS, and we had Hightower at the time all sitting at the table having this exact conversation. And I think we've progressed a lot. There are a lot of people like Jim and Julie that have been advocates, and Paul, you know, helping clients, and all of you, I'm sure in some fashion, have been struggling with this for quite a while. But so just having the conversation, I think, is coming a long way. What are some of the back of the house strategies that are working? Julie, why don't we start with you?
Yeah, I mean, I think it depends on, you know, whether you're talking about property operations or investment management, and I think I'm probably a little bit, I'm focused on both, but in terms of investment management, you know, some of the things are actually quite simple, like picking the right software programs that can integrate. And because we're not just a multifamily shop, because we have office, retail, and industrial, it's sometimes challenging for me to bring the multifamily investment platform in and integrate it with everything else because it's so unique, or different. I shouldn't say unique, different than the other in terms of lease structure and mostly lease structure, but operations are different. So, so we made a decision, for example, to bring all of our valuations into Argus. It took us 10 years. We tried it 3 times, right, before we got comfortable that it actually was a viable valuation tool for multifamily. We don't do it on acquisition. We still are in Excel for acquisition for sure. But by making that switch, we can now roll up our entire portfolio for funds that have multiple property types. So that was one big recent change. The other thing, which is kind of simple, and I think everybody will relate, is Teams has made us so much better. Microsoft Teams has allowed us to connect with our other offices that are not in Boston in a way that we couldn't before. Within the multifamily team, we have, so our team is maybe 15 VPs, and then analysts and associates that support, but we have multiple, you know, channels constantly talking to each other about, you know, hey, did you try this technology? Or, hey, how's leasing going in Austin? You know, just awesome. Today the post was, hey, I'm starting to feel that new supply. Lease trade outs just went negative in Austin. And getting that real-time data out to a broad audience where there can be a conversation that people can watch and see has been very, very helpful. We were doing it pretty well before, but Teams really opened that up.
The collaborative platforms is just amped, and I know we pushed our company into, you know, right after the pandemic started into Teams, you know. So.
I don't think it's such a simple thing. I think this is a major win for business across the board, and I think, you know.
And what's coming from Microsoft, just as a note, is incredible.
Oh, yeah.
I mean, the planned roadmap
Copilot stuff
is
gonna be so.
What is it?
Copilot.
Copilot, okay.
Yeah, there's some other things coming, so anyway.
Fun part about being on the panel is everyone has a little something, a little nugget.
Smart Sheets is another one, like I would mention, is just getting us out of Excel, and putting it in a place that everybody can, there's not multiple versions of the file.
No, it's not static
it
anymore. It's usable. It's
so
it's
those
real
are
time.
some examples of kind of the investment management side of things.
And also I think from like a team camaraderie side, like just in chatting all the time and expressing those small wins or even rallying around a challenge, like you can't, that's so amazing to be able to do that.
We have fun ones
the
now when you're on a property tour and you see something crazy, you know, they're doing the selfie with like, holy moly, did you see this space? Or
that's awesome.
You know, good and bad.
Yeah. I mean, you have Slack channels just for pictures of people's dogs now at work. Like it can actually be like part of the fun and part of the team building that we don't get in person across borders, which we never had. You never had that with your team in Austin because you're sitting here in Boston. So
exactly.
It's also a lot easier to build like social media for the company, right? Like everyone's using social media, like Yammer and Teams and things like that. It's like social media of your company. Those little snippets that you can get that expand the culture of the company.
And it's given us much faster and more personal access to the C-suite, you know, because they're doing it too. So new hires are hearing directly from the C-suite on a more regular basis in a it feels like just a more genuine way.
That's great.
I'll take it to a different place, which maybe is a little, kind of sounds less sexy, but like the communication with the team on the ground, the maintenance guys, and their ability to get a work order completed, have better inventory management, so they don't have to drive to Home Depot every time something happens. You can forecast a little bit the needs of the property better. It makes the employees' experience better. It makes the residents' experience better. One of the biggest challenges I found on the controllable side of the, everybody talks about the capital markets. The NOI is also an important component, and expense is an important component of the NOI. And what's the biggest ticket item that you can actually control is probably payroll, right? You can't control insurance, you can't control taxes. And one of the things that have changed since the pandemic, the turnover of on-site employees is huge. And replacing them is extremely challenging. So anything that we can do to make their lives a little bit more efficient and better and reduce the amount of turnover on that side is, at the end of the day, it affects the bottom line. It improves the bottom line, and it improves the experience of both the residents and employees. So, I'm always thinking about who's my stakeholders and how do I check their boxes? And I think that's a big one.
Let's stick with you, Noam, for a second.
All right.
So in this market, many portfolios and developers are facing capital constraints and considering where should they put their eggs for highest impact. How are you tackling this? What's your best advice?
I think I just gave it. No, but it really is on understanding what you can control and what you can't, and getting over bottlenecks in operations. And it comes down to the people. So we also spent some, invested in some technology on the investor side, but I think through our third-party management relationships, we're focusing on third parties that really are taking advantage of technology to improve the bandwidth and the experience on the ground. And at the moment, I think that's really where we're focusing on.
Julie, how about you?
So advice for developers, that's a tricky one right now. Can you get the cost down and the rents up? I think if I were going to say something to that, because I think it's a little bit tricky, I think there's a math problem right now that is just going to have to work itself out. Big part of that is interest rates, right?
Sure.
But the way I guess we're thinking about development is it's all about relationships. We have some great relationships we've been developing for decades. We were early in the last cycle and we were rewarded for it. So when we can, we'll go. We're ready. I mean, the supply-demand imbalance is there. You hear it on every panel about multifamily. So we're trying to make sure that we take good care of our relationships with our partners who we've done business with for years. And though their phones may not be ringing as much right now, trying to make sure that we are still talking and sharing what we're seeing and hearing, in our markets and where the returns are, and understanding, what they're dealing with, because it's a challenging time for developers. But I think they all know too that that'll change, and it'll change probably pretty soon.
I love that.
It's just hard to, it's hard to go for it.
I think you're spot on. I think there's a few things you could do as a developer. I think you're spot on when you talk about expenses, where our job is to always drive expenses down as best we can without giving up quality in the product that we produce. So maybe some of the things that you might be doing is, and what's really interesting is, once you get to a 98 or 97 or 99% occupancy, wouldn't it be okay then to take some of the people that are there where those applications are coming online, and you're only filling maybe one apartment every couple of 3 days, depending on how many units you have? Wouldn't it be good to take that same person, that manager, instead of just managing and staying in one location at all time? Why isn't he or she going to multiple locations? Why aren't we bringing some of the expenses down? Because you don't need a manager once you get to a high occupancy sitting at that desk all day long. And you have the ability through Yardi and through technology for the customer and or the tenant to enter their complaints. That goes right to the maintenance department. Work orders are carried forth, and that program is addressed right away. But as far as additional opportunities for developers, we believe in dirt, right? We believe in buying dirt. I think today, if the opportunities a year ago or so to buy something at a 5 cap, fix it up a little bit and exit at a 4 cap, sure, I guess they existed, and there's a lot of people making money on that. But today, what are you doing? Those opportunities don't exist. My suggestion is to take, if you're able to have put away or you have dry powder, my suggestion is to buy dirt and start the entitlement process. Because as this slowly turns, and we're starting to see that turning, at least we are, in the northern part of Massachusetts, that will be an incredible opportunity to create value by buying dirt. I think the other opportunities that exist too is, and we're a little different, and I say this with great respect and humility, we're vertically integrated from the management team, but also construction. We started a construction company, and what we're doing now is peeling back some of those things that we're sending out to the subs or these other people, and we're handling it in-house. And so that spread of, and please believe me, it's a 20% to 25% spread that GC is taken. We're keeping that in-house. That's helping us lower some of our expenses. We have built, massive projects. We just did a $200 million project that our in-house construction company did last year. So, over the past 3 years, finishing at the end of last year. But now we're kind of looking at it and creating these small opportunities within all our developments that we're not outsourcing. We're bringing some of that work in-house. It's helping a little. It really is. It's really helping. And we're not paying that GC fee. We're kind of scraping that a little bit. Does that make sense?
You do see a lot of the national development firms too, and I don't know if you're doing this at all, simplifying design, and mostly in an effort to create a more affordable rent level, because it's necessary and because there's pressure at the highest points in some markets. But they're creating one bedroom, 1 2-bedroom layout, and so just to simplify the design, maybe there aren't exterior balconies or the facades are more simple. Are you doing any of that to try to?
Yeah, it's so interesting that you said that. So we have a lot of mills that we've converted. And one of the great opportunities with a mill that we decided to do is, in the past, you might have a bedroom, but you would have a wide width, right? Because let's say you would incorporate, 2 windows. And you can imagine a mill window is almost a wall of glass to some extent. They're large windows.
Beautiful.
So what we've done is, instead of creating, going widthwise, we put a loft in. We kept it under the square footage for building purposes. We 400 square feet, just enough under the certain codes that we were able to go in there with very little materials and not drive that steel all the way to the basement. You can do it to support of the space itself. So we turn 600 square feet with a 400 square foot loft into 1,000 square feet. Now we're more than our competitor for a 1-bedroom or 1-bedroom, 1 den, and we're able to give a greater value on the same footprint. So we've been able to create more units stacking in this mill space, and we just kind of took advantage of that volume.
Yeah, you're suggesting buying land. Do you find that, given the current market environment, investors are willing to buy into that proposition today? Or is it, because we're finding that we're not there yet. I agree with Julie, we're getting there.
Yeah.
But at the moment, we can't find a number that makes it work.
Yeah, so we're not just looking at land. We're actually looking at land and entitling it in a different manner. For example, we really feel there's opportunities now to buy that brick and glass ribbon building that litter the sides of the highway and on 495, 128, et cetera, et cetera. So what we're doing is looking at that, and not just looking at that office, we're looking at the excess land capacity and saying, how do we re-permit that for multi-use? How do we put a new skin on the exterior of the building for now, but how do we create a separation and take advantage of other people looking at that and saying, we have this office building, let's blow it out at 40 or 30 or 40 or $50 a square foot. Well, that's what we're buying multifamily space now, because we're taking advantage of the balance of the real estate. So, the banks are still lending on multifamily. If you're buying the real estate in these office buildings and you're buying 30 or 40 bucks a square foot, and we've done that, so it's there, and the brokers will tell you it's there. I just had a broker tell me yesterday, there's 20 acres and there's 200,000 square foot on the building, and they want to blow it out at $40 a square foot. All I could think of was the balance of the real estate, not really thinking about the $40 or $50 a square foot for the 200,000 square feet. It's how many units can we put on the other 15 acres, and that's where we're creating a lot of value. Does that make sense?
Yeah,
Very
totally.
interesting. So it sounds like a lot of different interesting advice for bracing for impact, partnerships and relationships, investing in those people, believing in the dirt and the value of that, all really important. And I think when it comes to people, this is another major pillar of the Embrace the Movement campaign. And so I think it goes without saying that the people and what's important to them, and getting into, Paul, maybe some resident trends, and what are you guys evaluating when it comes to, resident trends? How are you evaluating? We'll start with Paul, but I'd love to hear from all of you.
Yeah, these are the experts.
So important.
I
But kick us off.
I can tell you what our clients are talking about, and I think a lot of it has already been stated today. Like, the sense of community, looking for that sense of community.
Huge.
For sure. Amenities are the biggest things. Amenities and convenience, things like that, right? Multifamily is probably the hottest it's ever been. High interest rates are certainly helping that, with more people renting. People want to be closer together. They're spending more time at home, so they want those amenities. They want the flexible space and things like that, so they can work from home. They want that convenience. And also the demographic is with the Gen Zs and millennials now. These are digital natives, right? So they want everything on their phone at their fingertips. That's what they understand. So those things. The other thing, Sal had mentioned it before, I think ESG is like very, very important.
Huge.
So I think with those building materials, using those types of things of green buildings, air quality. I mean, Jim, we were in the other room there, and
I pulled up some sensors.
Pulled up some sensors
yesterday.
Of course you did.
From Princeton, just like what was going on in Princeton.
So I live in New
shocked.
Jersey,
I know.
and like our air quality yesterday was horrible.
Yeah.
And he's like,
I could show you what was coming in from the outside, what the filtration was doing, what we were delivering to our client space, and so.
I mean,
yeah.
that
So-
stuff is, that's what what
amazing.
people are demanding. So.
Yeah.
It would have been better to sleep in his office than my house.
You know what? I believe that.
Your house was worse than
I
you
believe
should have come
that.
to the office.
Well, and so,
Yeah.
speaking of which, the intuitive building, the smart building, I'm sure you get asked about this all the time, much to your dismay, I imagine, but what does it actually mean today?
Yeah, so I know I have the saying, like, the term smart building has been around for 20 plus years, and we're still in early innings of realizing whatever that means.
Whatever that means.
So I always say that we have, instead of smart buildings with smart technologies, right? So we have smart technologies that we embed in our buildings. They may not all come together, because I think the state of nirvana, or whatever it is about a self-tuning, self-commissioning building that tunes itself, and it is within reach. I mean, all the tech that we're talking about, I'm hope, and I know people are pushing the envelope, but by the end of the decade, we achieve that, and all this enablement that we have is helping us get there, right? And the ESG and the decarbonization push is a driver for the adoption of these technologies and the data layers that allow you to do this, right? So that's really from my perspective, But we're doing a lot with access control. I have this, we have Apple Wallet enablement with mobile credentials. I have a major client in New York City, probably one of the busiest turnstiles in Midtown Manhattan, and we just got analytics Tuesday. Had over 550 people use their Apple. No issues, just like
Amazing.
a card, right?
Wow.
At one of the busiest turnstiles in New York. So we're literally going through a modernization of our New York portfolio. It's going to come to Boston. It's going to go to San Francisco, other buildings. But that's another example where you're as a multi-tenanted landlord, we have a moment in time where you traverse space that we control. I mean, I'm sure it's similar in the multifamily. So how do you think about that convenience, that getting through that journey? What are we offering in that journey and traversal of space? You leave your home, you go through public space, you come through landlord-controlled space, you go into the employer space. We don't really, there's a boundary at that door, at least in the office, and we have a lot of major Fortune 1000 companies in our portfolio, right?
Well, and that was my next question: is how is the connection? And again, today, because there's been a while since we've talked, and a lot has happened. Where's that connection between the resident waking up in their apartment and getting to that office, and how much technology, how much of a hand do you have in that experience, and do you have, and do you have?
Well, I mean, you have to fill the gaps.
Yeah.
Like that gap until you get to the employee. Like all those gaps. I talk about gaps, and so it's about the layer of services, the layer of data. From data service to having your phone. Never lose a heartbeat up to the 50th floor of a building. I mean, that's really important.
Jim,
you know.
are you using that as another revenue driver, that space, or that's so immaterial you just want to use it to get more people in the office?
Yeah. So it's really about, I mean, for us, Paul, like we are a, you know, we don't say we're a Class A office company anymore. We're premier workspaces. And that lens of the clients we serve and as Fortune 1000 companies is the lens of that experience and that journey and what's expected, right? So if we're marketing, competing in the market, it's with that lens and perspective, right? So.
And in the last few years, I think a lot of people have started to talk more about this kind of like designer portfolio association with a brand name and the seamlessness of that experience that they can expect walking into a Boston Properties building or a Lupoli building, right? And so what does the intuitive smart building mean for you, Sal? I know you are implementing technology. You talked a little bit about it in the beginning of the session.
Yeah, I think what people want to do is just, ease of use, right? Like they...
Seamlessness.
Seamlessness.
Yeah.
All our new buildings, you're able to open all your doors with your phone. And sometimes people think that's not a big deal, but it is, because that just takes less expense out of the maintenance department and or the building itself. To be able to control your temperature on your phone as you're starting to come in, that's a big deal.
Incredible.
And I think what people don't understand is, and they underestimate our customers, because our customers are thinking about that all the time. And that sometimes is the reason why they sign with you as opposed to somebody else. I mean, they tell me I can turn my heat down during the day, and when 15 minutes before I come home, I can turn my heat up. I can do that with AC. I can unlock my door. I don't have to worry about it. And what's great about it on the expense side is, no more keys, no more paperwork to fill out in certain applications.
Yeah.
We're sending you the code. You have your new code on your phone. It's all done. You move out. I cancel that code. Next person. And so, the customers are really appreciating that.
Yeah.
And I totally agree. Where again, the mobile enablement's great. I get more excited about the efficiencies and the enhanced security.
That's right.
That come all along that path. I mean, they're equally as powerful.
I think it's all about the customers, and today's customers in multifamily are the most sophisticated, the most knowledgeable. They know a lot more than I do. So that's why we spend so much time actually trying to listen to them.
That's awesome.
Because I'm not up to speed with everything you are. But
Well, there's so much more information available, right? Like you have to be there because they know that, because the guy down the street has it, right? And before that took work. Now it's just a website like they could go to. Yeah.
But I'm risk averse to some degree, and I have to think constantly on what could go wrong, right? So we talked about a little bit about California regulations, about how they handle data. I deal with the European and
GDPR.
Group. GDPR
Yeah.
is draconian, and their operations in the United States are impacted by regulation back in Europe. And on top of it, and in terms of technology, keyless entry is great, except that the one system I had in one of the properties had a virus, and it had a virus on a Sunday. So nobody can get into their apartment, and the computer is in the office. To get into the office, it's the same keyless entry. So now you need to break into and of course, we were trying to be ahead of time and use a very proprietary technology, and nobody can service it. So I'm always kind of like trying to, how do you mitigate those risks? How do you are ahead of your competitors, but at the same time mitigate your risk?
Well, that's a major question in implementing any technology, is who's going to fix it when it breaks, right? And that's a major question. I think a lot of prop tech companies don't realize that they will be getting that question upon pitching to all of you, and it's a pretty harsh wake-up call, I think, when they don't have that answer. So,
there are alternatives. You're 100% right. So not only think about it, if your battery to your phone is dead, like how are you getting into your apartment? So what we also do is provide you the fob. So for whatever reason, you don't have your phone, it dies, or you don't have, for whatever reason, you left it in the car, you can still get into your house because your fob is still on your person.
I had a moment last week because my battery was dying. I only could use my phone to get into my apartment in Boston, and I was like, oh boy, what am I? My brain was going plan B, C, D. So
I would have loved to see that happen.
So,
oh man!
But managing risk is like being risk focused on like any adoption you're doing, and it partners, it's like, choosing the right horses.
When it's hard to know what's around the corner.
Yeah.
Yeah.
And the support, the level of support you're getting, right, is crucial.
Yeah.
I have a really important last question, and we don't have too much time left. This went by very, very quickly. I do want to talk about AI because I think it's a big ticket item in almost every conversation in the world, let alone in business, let alone in our industry. So do you anticipate AI changing the nature of the multifamily industry? And if so, how? Or really, let's get rid of the if so, let's talk about the how. Who wants to start? This is an everyone question.
I think it already has. I
Yeah.
mean, like with chatbots and with tours, that you can take, like it's already changed the way that tenants are finding out about properties, approaching properties, and things like that. But it's still got a long way to go, and it comes down to data, right?
Absolutely.
And it's in the background in data analytics, right?
Yeah.
Like utility usage. We have a system that will tell you if there's a leak there's a water leak somewhere, right? There's nobody sitting and monitoring it. It's AI that's doing the analytics and raising a red flag over it. So it's in everything, but I think the quality, I go back to the quality, and I go back to the fact that you have to, like ChatGPT, sometimes, what's the term? That
Hallucinations.
Hallucinations. Like, it doesn't always give you what you think you're getting. So
Right.
Yeah.
I think it's still, it's in
Yeah, I think the way obviously AI's been around for 20, 30 years, right?
Sure.
It's embedded in everything we do. It's just that this generative AI that was, launched in November and then updated in March, it's more about the words and the images. It's a different type of AI that's being applied here. So it's really, for me, like these early innings, it's a productivity accelerator for people. So it either gets you 20, 30, 40% there as a technology. It will get you there, and you have to then intervene, 60, 70 potentially, right? So depending on your role, depending what you're trying to use it for, these applications and use cases are, I personally, as a technologist, we're at a pivot point. It's an inflection point that is a significant one, and it's going to be used it's going to have good technologies. I'm excited about the good, and then trying to mitigate the risks and the bad, right? So that's kind of how I look at it. So
Totally.
Do you have any prediction on what part of multifamily is most affected?
Well,
is it marketing?
Yeah, well, marketing is an easy one. So
Right.
I was telling Paul earlier, we have an intranet site, very active, lots of feeds. We have an employee base around 100 sites around the company, and we feed it constantly. So we're doing an update this fall, and our vendor is incorporating it into the tool set. So someone who's composing material content, like obviously that's the copyright, is really meant. It's easy. It's a tool you can hop over, simplify, clean it up, augment it, get it in. So that's the kind of things when you think about the written word or visuals.
We just spent a decent amount of time and money branding a property in Miami, and somebody for fun went off to the side and said, "Hey, ChatGPT, here's what I can tell you about this property we're building. What should we name it?" And it was kind of fascinating.
Wow.
How close they came to being good enough.
It's, again, it's a productivity
and like you said, it got
accelerator.
us 70% of the way there, maybe.
Right.
Yeah. And some of them weren't very original, but yeah.
And chatbots used to be a series of questions and answers. I've seen chatbots that you can ask it to, like, tell me a joke, and it will. Like, there's more than just a set of questions and answers.
So I should do that on my airline site and try that out and see what kind of answer they get back.
See how much fun you can
See how
have.
creative the guy
Right.
You know what's exciting? Using AI, and you can see it in the construction. I'll give you a couple of examples in each sector. So in construction, we use AI because now we're able to identify where all the trades are running their pipes, wires, any utilities through above the ceiling, below the next floor. So if we can compress them and everybody can lay out exactly where they're supposed to go, as opposed to, okay, it's your turn to come in, you're the ductwork guy. Usually those trades, they fight to get in first so nobody's in their way. But if you, and we just did it on our last project. Yeah. And if we can signify exactly where your space is going to be, then we can compress the steel, and instead of giving more volume because we're not sure where people are going to go, we can compress it a foot or 18 inches. That's a big deal on the price cost of construction. It's actually also fun to use, and we allow this for a small fee. You can change the color of your apartment. We're not going to pick it. You pick it. You go online, you'll be able to see some of our products. You'll be able to say, what does a blue wall look like? What does a red wall look like? And believe it or not, if we give that power back to the customer, they get like part of the
They're having fun.
They're having fun.
An emotional investment that you
That's
can't.
exactly right. They're emotionally invested in it. And all of a sudden, our customers will say, can you accent that wall and accent? Now, we're going to paint every single wall in every single place as the turnover comes. That's what we do. Every wall gets painted. So all we do is we wait till that new customer comes. We know we can bang it out in a few hours. We'll get that customer involved. And all of a sudden, we're making up the cost of what it costs us to paint it because you decided you want these two walls to have a particular accent. So that's fun. That's a way of bringing the customer in, becoming interactive with that. I think on the commercial lens, on the office lens, and we have millions of square feet of that, there's something to be said about, we call it, control panel NASA, to be able to turn power off, utilities off, on the weekend when there's nobody in the office buildings. Why are we running certain powers at certain temperatures? Only because that's the way they used to always do it. But now, at your dashboard, with AI, you can change all that with one button. That's a big deal when you talk about the cost of utilities today. So
Absolutely.
those are just some examples.
Yeah, and I think this is where the intuition of the building can grow around its users to such a vast extent, right? And learn about you as an individual, learn about your preferences, learn about how you use the building or your own apartment, talk about helping building owners reduce their carbon footprint, maybe in a way that wasn't possible before. You learn about the tenant. When are they there? When are they not? When can I lower the AC a little bit or the HVAC, heating or cooling? To save a little bit, overall, office or multifamily. I mean, wow, these are some really exciting things that we're talking about. We'll have to have a whole separate conversation for all the big scary things that I imagine are also coming with this AI revolution. But I think that's just about the time we have. I didn't even get to half these questions. You guys are so good. That was incredible. So thank you so much for spending the afternoon with us.
Thank you.
Thank you to everybody who joined us via the live stream from wherever you are. I hope you enjoyed this as much as I did. I just want to say thank you to everybody who participated today. These were some really fantastic conversations. You guys can watch the first session in the replay. Thank you to our host, Industrious, to Cone Resnick for being amazing collaborators. And that's it for us for the day. So thank you, everybody. This was awesome. Thank you.